We're having to pay the piper for a lot of sins, Elijah, and it seems that he's coming with his hat and his spear to make sure we stump up real deep.
I mean, the whole thing is an absolute mess. The underlying point is there is so much zombie debt within the private sector that higher interest rates, which are inevitable now, are going to drive the whole economy under.
I just want people to understand that it's a whole lot more than just Trump tariffs or trying to take advantage of arbitrage. We are at a place right now where desperate times call for desperate measures. We have $28 trillion in U.S. Treasuries that are due in 3 years, Dunnigan. Where's gold fit into all this? Don't know, man, but don't be surprised when you're surprised as to what shows its head in the coming days.
You're watching Silver News Daily. Subscribe for more.
The world is sleepwalking into a financial catastrophe, and most people have no idea what's coming. The global economy has been propped up by debt, artificial money printing, and blind faith in a fiat system that is now unraveling at breakneck speed. Central banks are panicking, the bond market is collapsing, and inflation is running wild. But while the mainstream media distracts you with temporary market rallies and political drama, the real story is unfolding beneath the surface, an event that could send silver prices into uncharted territory. Andy Schectman, Alasdair Macleod, and Francis Hunt all warn that the writing is on the wall. The financial system is imploding, and silver is positioned to explode past $100. They're not just speculating, they're following the undeniable signals that have preceded every major silver bull run in history. The warning signs are all there. In 1980, silver skyrocketed from under $6 to nearly $50 as inflation spiraled out of control. In 2011, silver surged again, nearing that same $50 mark as central banks flooded the markets with liquidity. But this time, the stakes are even higher. Right now, silver remains one of the most undervalued assets in the world, sitting at a fraction of its historical highs while gold breaks records. But that's about to change. The forces driving silver's next move are bigger than anything we've seen before. Crippling debt, a collapsing dollar, supply shortages, and a global loss of confidence in fiat currency. And when silver finally wakes up, the move will be violent. So how high could silver go? And what are the key triggers that will send it soaring? Stay with me, because by the end of this, you'll see exactly why silver's breakout past $100 is not just possible. It's inevitable.
In the world. Why? There's an understanding by the knowledgeable central bank investor, the most knowledgeable investors in the world, just what silver and gold represent. And that understanding has been whitewashed from the United States investment vernacular. And that's why so few people will benefit from this. And why the people listening to you and I, some of them must say, shit, I hear this all the time. It's getting tiring already. But I mean, it's been evident to me that this is a trend since 2020, when I said all of a sudden the exchanges are being delivered on. No one ever did that before. And it's been a gradual process. And this new administration, I think, came to Trump and said, here's what's happening, and you better do something about it, because the world is standing up against the paper derivative market to their advantage. And we're going to be left in the cold with an inability to source these commodities if we wait much longer. And that's why I think they've done it under the guise of tariffs, done it with virtually no fanfare. And that's maybe why Scott Bessent backtracked from saying he's going to remonetize the assets. Everyone thought it was gold. Maybe Trump said, you dummy, what do you do that for? You don't want to cause attention to it. So, Cynthia Loomis did the same thing. In her bill, she advocated for revaluing gold. And then in another bill, she said we should sell the gold. So it's almost like, or another interview, she said we should sell the gold. It's like they're backtracking. Maybe they were premature in making these declarations, but I don't know. Something in my gut tells me that this is moving in a direction that is going to reintroduce gold in particular into some form of a new monetary system, or at least backing U.S. Treasuries. And as far as silver, look, there's a 90% correlation throughout all of history between the two, and it's a strategic metal. And I think that's been realized as well. And when Scott Bessent, say what you want about him, but when he was running a hedge fund, his largest holding was gold. He understands it. And evidently other people do in the administration. So yeah, I think this is legit. I really do.
For decades, the global economy has been built on a foundation of debt, cheap credit, artificially low interest rates, and relentless money printing. This debt supercycle fueled stock market booms, government expansion, and the illusion of endless prosperity. But now that cycle has reached its breaking point. Interest rates have surged, governments are drowning in debt payments, and central banks are backed into a corner. The very system that sustained economic growth for over 40 years is now eating itself alive. Francis Hunt warned that the end of this debt cycle is unlike anything we've seen before. The 40-year bull market in bonds is over, and that means the safety net of the financial system has been ripped away. Bonds were once considered the stable foundation of investment portfolios. Boring, predictable, reliable. But today, U.S. bonds, once seen as the ultimate safe haven, are selling off aggressively. Governments are forced to roll over trillions in debt at higher and higher interest rates, creating a doom loop that can only end in disaster. The U.S. is now spending over $1.2 trillion annually just on interest payments, more than its entire defense budget. That number will only grow as more debt rolls over at higher rates. The same story is playing out across Europe, Japan, and emerging markets. Governments that once relied on cheap money to finance their deficits are now staring at a financial abyss. The options? Print more money, let inflation run out of control, or default. None of these outcomes are bullish for fiat currency, but all of them are bullish for silver. We've seen this before. When confidence in fiat money collapses, real assets like gold and silver explode. In the 1970s, when inflation spiraled out of control, silver skyrocketed 800% in just a few years. In 2011, when central banks were debasing currencies at record speed, silver surged again. Now, with debt at unimaginable levels and inflation far from under control, we are setting up for the most extreme silver bull run yet. But it's not just about fiat money losing value. Silver has another explosive force behind it. A force that could make this bull run even bigger than anything we've seen before. Gold. Gold has already broken out, hitting $3,000 an ounce. And history tells us that when gold leads, silver follows. But not just follows, it surges at an even greater pace. The real question is, when will silver catch up? And when it does, how high will it go? How high?
Exactly. Because, I mean, from a banker's point of view, if you see deteriorating economic conditions, then that equals risk. So how do you cover that risk? Well, you need a higher return. And then you sort of think, okay, if, this company which Dunigan Kaiser is running, isn't really all that profitable, will it bear a higher interest rate? The answer is no. So we want our money back. Thank you very much. So you can see how, this is actually how the credit cycle works. And the problem that we've had is that really since about the mid-1980s, every credit cycle, the Fed and, the Bank of England and the Bank of Japan, whatever, and the predecessors of the ECB have jumped in and stopped the liquidation, if you like, of bad businesses which have unproductive loans, the zombies. Good political reasons, but very bad economic reasons. The result is that, all the distortions of a credit cycle just get wound up into the next credit cycle. And you don't necessarily see the cycle in terms of, money supply because, it sort of constantly increases as a result of this. But what you end up with is an absolute mountain of bad debt. And I mean, we know this. If you look at the debt side of everything, I mean, the amount of unprotected debt is huge. And of course, you get people who play the cycle and get it incredibly wrong. The private equity industry in this country is a very good example. When you had Thames Water, which is one of our largest utility, it serves the whole of London and surrounds. very big company. Now, the water industry is regulated. We've got a regulator, and the regulator tells the water companies, how much money they can make and how much money they've got to invest in terms of their infrastructure.
Gold has already made its move. It has shattered all-time highs, crossing the $3,000 mark as investors flee the collapsing fiat system. And history tells us one undeniable truth. When gold leads, silver follows. But silver doesn't just follow, it overperforms. Every major gold rally in history has been followed by an explosive surge in silver. And this time will be no different. Look at the patterns. In 1980, gold soared past $800 an ounce, but silver? It didn't just climb alongside it. It skyrocketed from under $6 to nearly $50, delivering a staggering 800% gain. The same thing happened in 2011. As gold broke records near $1,900, silver launched from just $9 an ounce to almost $50, obliterating expectations. Each time, silver lagged behind gold at first, only to explode when the market finally woke up. And right now, the setup is identical. Gold is already at record levels, yet silver remains stuck in the mid-20s, far below its previous highs. But make no mistake, silver's moment is coming. Francis Hunt has emphasized that the gold-silver ratio is one of the most critical indicators to watch. This ratio measures how many ounces of silver it takes to buy an ounce of gold. Historically, when this ratio gets stretched too far, silver violently corrects upward. Right now, with gold at $3,000 and silver under $35, the ratio is flashing an extreme reading, meaning silver is historically undervalued. And when the ratio corrects, silver doesn't just rise, it surges. But this time, there's even more fuel behind the silver breakout. Unlike gold, silver has two major demand drivers: monetary demand and industrial demand. As central banks abandon fiat and investors rush into precious metals, silver is not just a monetary asset. It is a critical industrial metal, used in everything from solar panels to electric vehicles. This double demand dynamic is setting the stage for silver to rise faster and more violently than ever before. So the question isn't if silver will follow gold, it's when. And when it does, the move will be breathtaking. But there's another factor that will make this breakout even more dramatic: the collapse of the paper silver market. For years, institutions have manipulated silver prices through futures contracts. But those contracts are now unraveling. What happens when the world realizes that there's far less physical silver available than the paper markets claim?
Americans to think that there's some guy offshore is just beating up on America and saying only bad things are coming for America. Western Europe are due for a very similar and are equally deserving, maybe more so, of what's coming. In short, the entire Western realm, the Commonwealth, right the way through, Australia, Canada, the UK, as well as Europe, are in for a big trouble, and they are desynchronized. They're both going through the same process, but in alternative ways, alternative timings, and it's quite fascinating that. Before I take you there, because I hear your question and I definitely want to handle that, I'm just going to whisk you through a couple of comparatives of gold against other benchmarks just to make a point. And then you will see why I say when the European debt starts to fail, which is what the case I'm going to be making, this is going to be further turbo juice, further confirmation of the reserve asset status of bonds never being truly merited in the first place, and the folly, and that the 40-year bull market in bonds is in fact over. But getting there, there's a whole deleveraging that occurs, and the Nasdaq is one of those things that have done very well out of leverage. I think there's $1 trillion in margin leverage that has been used in stocks. Just imagine that unwinding. So if I just put up the IXIC, Nasdaq divided by gold, this looks like a downside turn in Nasdaq overperformance relative to gold. We're looking on a weekly time frame. This is not a small time frame chart. You had quite a robust hit. We had a bit of a rally, and then we've since squeezed here, and you're having a breakdown to the downside. So again, gold looks like it's going to overperform Nasdaq. This is a tech off, gold on trade. Much like our gold on oil as a counterbalance, only now you've got Many Americans very into the stock market, 401ks, etc. I covered gold and oil, so I won't do that again. Many people look for solace in the fundamentals of crypto, and I'm here to say, be careful out there. This is Bitcoin divided by gold. And these are very interesting trend lines that have been in play since the original surge. And that would have been when, the market cap of Bitcoin would have been minute and it was being moved exceedingly high. Since 13, you have had a basing ascending grind line, which many people technically refer to as a trend line, that has been in play as support for Bitcoin's overperformance to gold, technically. And now what we're actually seeing is this. And then I'm going to take my pink pen and draw the latest line. That is that. And it's far more grinding along the lower range along here. Now, technically, I'd be very concerned as a Bitcoin fan that the next move isn't downside. Excuse me. One more. So we could indeed be seeing a little bit of a breakdown and a little bit of a gloss coming off the alleged digital value of gold, digital gold versus the real thing. And as someone who puts gold first and foremost, it doesn't surprise me, but it might upset, offend, or be a useful alert, depending on what people's mental posture are, that think that crypto is going to be a hiding place. They miss getting into gold early in the beginning. By the way, in terms of gold against industrial metals, it's really not got away against copper yet. So even commodity, pure industrial commodity. Only in China is there a semi-precious metal.
For decades, the silver market has been dominated by paper contracts, futures, ETFs, and other derivatives that claim to represent physical silver. But here's the dirty secret. The amount of paper silver traded far exceeds the actual physical supply. The London Bullion Market Association, LBMA, and the COMEX futures market have been the primary tools for suppressing silver prices, allowing banks and institutions to keep silver artificially cheap. But that system is now breaking down, and when it collapses completely, the silver price could explode overnight. Andy Schectman has repeatedly warned that the COMEX and LBMA are operating on borrowed time. The system relies on traders believing that they can always convert their paper silver into physical metal, but the truth is, there isn't enough physical silver to cover the promises made on paper. Right now, for every ounce of registered silver in COMEX warehouses, there are dozens, if not hundreds, of paper claims on it. This means that if even a fraction of investors demand delivery of real silver, the entire system could be exposed as a fraud. We're already seeing the first cracks. In recent months, COMEX inventories have been rapidly drained, with physical silver leaving the exchange at a record pace. LBMA silver stocks are dwindling, and refiners are struggling to keep up with demand. Yet, despite these alarming signs, silver's price has remained artificially low, until now. As more investors wake up to the reality of paper silver manipulation, a tipping point is inevitable. When institutions can no longer meet physical delivery demands, confidence in the system will collapse. This will trigger a massive short squeeze, forcing silver prices higher as traders scramble to cover their positions. We've seen glimpses of this before, like in early 2021, when retail investors tried to force a silver short squeeze. But this time, it won't just be retail investors. It will be global institutions, sovereign wealth funds, and central banks shifting out of failing fiat currencies into real assets. And here's the kicker. The paper market breakdown won't just push silver higher. It will expose the true supply shortage that the world has ignored for too long. The reality is, there's not enough silver to meet both investment demand and industrial demand, and once the manipulation ends, the real price discovery begins. So what happens when the world realizes that silver is far scarcer than the market has priced in? We're already heading toward an unprecedented silver supply crisis, and when the paper market fails, it will be physical silver, not paper promises, that determines the real price.
To distance themselves from the LBMA. In the last 3 months, 128.5 million ounces of silver have been withdrawn from London. And so you're talking almost 50% of the float gone in the last 3 months. in silver. So between the amount of silver and gold delivered, not to mention all of the others that are standing for delivery, but they're being told it's 8 weeks. It seems like they're turning up the heat. And maybe, just maybe, that rumor of Trump trying to stick it to the Bank of England is really true after all, because this is a very provocative move. And I think, it really does speak of the LBMA losing confidence globally in its ability to deliver. And this is the beginning. So I guess we'll see what the real reason is. Much like most of the things we've seen lately on the LBMA and COMEX, we can assume and surmise what the real agenda is. Mainstream would tell you that's not the case. I don't believe it. I actually feel that we are witnessing a shift from this paper market that all of us thought would never be broken into other hubs like Shanghai, like Moscow, like Dubai. These are cash and carry exchanges where the price setting is far more realistic, instead of a futures market where it's 90% paper and 10% physical, and no one ever stood for delivery. And you and I have been talking about this, and the logarithmic decay, little by little by little by little, and then bang, are we at that point? Well, it sure feels that way when almost half of the available silver has been drained. And now they're saying it's logistics. We can't really get it over to you as fast as we would like. Demand for physical gold and silver is rising. And this is a move away from the Western markets. It's a big deal. We'll see how big it is. But yeah, I think this is something people really need to pay attention to, on top of the fact that it just continues to move higher. It seems almost every day now.
Silver isn't just a monetary metal, it's an industrial necessity. And right now, the world is sleepwalking into a catastrophic supply crisis. For years, the silver market has been quietly running deficits, with demand outpacing mine supply. But now, with industrial consumption exploding and above-ground stockpiles dwindling, we are reaching a breaking point. Once this shortage becomes undeniable, silver's price could go parabolic. Alasdair Macleod has warned that most people still don't grasp how critical silver is to modern industry. Unlike gold, which is primarily hoarded as a store of value, silver is actively consumed in industrial applications, many of which have no viable substitute. It's a key component in solar panels, electric vehicles, medical technology, and the entire green energy revolution. And yet, despite this soaring demand, mining production has stagnated, with no major new silver discoveries in years. Let's talk numbers. The Silver Institute reports that in recent years, industrial silver demand has hit all-time highs, fueled by solar panel production alone consuming nearly 20% of annual supply. Electric vehicles require even more silver, with each EV using nearly 2 ounces per vehicle, a number set to grow as global governments push toward electrification. Meanwhile, 5G technology, medical equipment, and even military applications are increasing silver consumption at an unprecedented rate. But here's the problem. We're running out of easy-to-mine silver. Most of the world's silver is a byproduct of other mining operations, mainly copper, zinc, and lead. As those industries face their own supply constraints, silver production is suffering. Worse yet, many of the world's largest silver mines are in politically unstable regions, where government intervention and nationalization threats make future output uncertain. And then there's China. China is one of the largest consumers of silver, and it has been aggressively stockpiling metals while restricting exports. If China decides to limit silver exports while continuing to hoard domestic production, the Western world could face a devastating supply squeeze. The signs are already flashing red. Major silver vaults, such as those in the LBMA and COMEX, are seeing record withdrawals, with institutional buyers quietly draining inventories. At the same time, retail investors are waking up, with premiums on physical silver skyrocketing as availability shrinks. The stage is set. A perfect storm of rising industrial demand, stagnant mining supply, and dwindling above-ground reserves is brewing. And once this supply shortage becomes impossible to ignore, silver's price will have no choice but to reprice drastically higher. But there's one more factor that could supercharge silver's move past $100: the collapse of the dollar's dominance and the global shift toward de-dollarization. Nations are moving away from the US dollar at an alarming rate, and silver is about to play a major role in what comes next.
Yeah, there are two levels of this, obviously. I mean, the one is the investor level. Is usually people talk to me, they're trying to protect their wealth or preserve their wealth. And the answer is quite simple: get out of credit. But then you've got a problem that, they're used to, diversifying their portfolio. So the idea of putting everything into gold or gold and silver or whatever, is completely alien to them. It really is. But I still say, look, get out of credit. But again, you've got the problem that no compliance officer is going to sanction that for a start. Everything that is if you like, a regulated investment is actually credit. So this is complete denial of the existing system as far as the establishment is concerned. But you're right to point out there is this other side of it, and that is that you've got debt in the form of mortgages. Most people have got this. And it's a question of how they handle that. Now, I would say that in a real credit crisis, it's the banks that got the problem rather than you've got the problem. That's the first thing. But it's something that you could probably manage if you make sure that communications from the bank are answered, that you appear proactive. What that means, I think, is, and I don't guarantee this, but I think what it means is that in terms of lender psychology, if somebody is, seeming to be quite helpful and understands the problem and all the rest of it, that, as far as the lender is concerned, is less of a problem than someone who just ignores your correspondence or is rude or whatever. Those are the guys who are going to get foreclosed first. And as well as that, of course, everything is so political. I think that the political class will tell the central banks to tell the commercial banks, do not foreclose on unfortunate people who...
The world is losing faith in the US dollar, and central banks are making their move. For decades, the dollar's dominance has been unquestioned. It was the global reserve currency, the backbone of international trade, and the lifeblood of financial markets. But now that system is unraveling. Nations around the world are actively de-dollarizing, and as confidence in fiat currencies crumbles, silver is emerging as a critical asset in the new monetary order. Andy Schectman has been sounding the alarm. Central banks are not buying dollars. They're dumping them. In 2022 alone, central banks purchased more gold than at any time in recorded history. But while the headlines focus on gold, silver's role in this global shift is just as important. History has shown that whenever gold is revalued in a new financial system, silver follows, and it moves faster and more violently. Why are countries abandoning the dollar? The answer is simple: debt, inflation, and weaponization. The US has printed trillions of dollars out of thin air, fueling inflation and eroding trust in the currency. Meanwhile, the freezing of Russian assets in 2022 sent a chilling message to the world. If a country holds its reserves in US dollars, those reserves are only safe as long as they obey Washington's rules. This has led major economies, including China, Russia, and even US allies like Saudi Arabia, to seek alternatives to the dollar. China and Russia are leading the charge. They are not only stockpiling gold at a historic pace, but also setting up alternative financial systems that bypass the dollar altogether. The BRICS nations, Brazil, Russia, India, China, and South Africa, are developing their own trade settlement systems that reduce reliance on the dollar. And Saudi Arabia, long seen as a pillar of the petrodollar system, is now openly discussing oil trade deals in Chinese yuan. This de-dollarization trend is extremely bullish for silver. Why? Because in every major monetary reset throughout history, silver has been a key component of the new system. When the US abandoned the gold standard in 1971, silver prices soared in the years that followed. When the financial system was flooded with cheap liquidity after 2008, silver rocketed to $50 an ounce. And now, as the world moves away from the dollar, silver stands to benefit in two ways: as a monetary asset and as a critical industrial metal for the new energy economy. But here's the real kicker. If the US is forced to revalue gold in order to stabilize the financial system, silver will follow with even greater intensity. The gold-to-silver ratio, which currently sits at extreme levels, suggests that silver is massively undervalued relative to gold. When this ratio corrects, silver could easily outperform gold by a factor of 3, 4, or even 5 times. And this brings us to one of the most overlooked indicators of silver's explosive potential, the gold-silver ratio itself. Historically, whenever this ratio gets too stretched, silver experiences an aggressive price surge. The data is undeniable. Every time gold breaks out, silver lags behind until it doesn't. Then, when it catches up, it does so with a speed and force that leaves investors stunned. So, how does this ratio signal that silver's next move will be unlike anything we've seen before? And what does it tell us about how high silver could actually go?
4.2 for the Dutch, you could have been borrowing at 2.5 like the Germans. So now you've got the nations of Holland, you've got the nations of Germany, you've got the nations of France, all looking at significantly higher borrowing costs. Their debt is going to collapse, their rates are going to go up. US went through that. Remember, every nation is a debt instrument, UST, and its currency, USD. They don't tell you that because they don't want you to focus on the debt. They say it's all about the currency. No, it's about the debt and the debt devaluing, and these guys are going to do it too. So, and the final one I'll leave you on, that all things EU, although the British are not in the EU anymore, they are going to be in even deeper trouble. And the point people have to remember is when rates go up, housing markets fail. Housing markets get more expensive, borrowing gets more expensive, leverage in the system for buying houses suddenly starts to get caught out. Here's where we are on the UK, very similar structure. It broke earlier. They had a pension crisis, you might remember, last year. It broke earlier, and they are on track to run 5.8. That could be almost making a 6% with a bit of overrun. Our targets are never just met, they should be run. That is going to be devastating for the UK housing price. And what you saw recently, since debt is no longer an asset, you had rate cuts, but actually US homeowners had bigger interest bills. So because of the loss of confidence in debt instruments, the margins required by banks are getting ever higher. The security they're requiring ever higher. The interest rates they charge. So when you're getting the cuts, you're not getting so much of the benefits. Now imagine when you get the hikes with that additional margin that banks are going to require because of their understanding. The CEOs in banks understand that they are in a debt-based collapse. There is a rush for gold. Believe you me, they may not be saying it, they see it and they understand it. They need a bigger pound of flesh. So this is devastating for Europe because they're about to go the path of what the US already did post-COVID when they printed up so much money. So the US did it for the COVID response. The Europeans are now going to do it for their military industrial complex response. They're already on very high tax rates. Their consumer is going to get totally wrecked in their forthcoming recession. Their property markets are going to collapse under the burden of it. They're not going to be as bid up, particularly dangerous to the UK, which is very property reliant.
The gold-silver ratio is flashing a massive buy signal, one that has historically preceded some of the biggest silver bull runs in history. This ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been stretched to extreme levels, signaling that silver is long overdue for a violent upward move. Historically, whenever the gold-silver ratio exceeds 80, it marks a turning point where silver begins to dramatically outperform gold. Right now, with gold sitting at $3,000 an ounce and silver still lingering under $35, the ratio remains dangerously high, suggesting that silver is severely undervalued. And when this ratio corrects, silver doesn't just rise, it explodes. Let's look at history. In 1980, as inflation spiraled out of control, gold hit record highs, but silver outpaced it with an 800% gain, sending the ratio plummeting. In 2011, a similar pattern emerged. Gold rallied to $1,900, but silver surged even harder, bringing the ratio down to 32 to 1. Now, with gold already making new highs and the ratio still above 85, silver has enormous catching up to do. Francis Hunt has pointed out that silver moves in extreme cycles, and when it finally breaks out, the gains come fast and furious. If gold continues its upward trajectory, even a modest correction in the gold-silver ratio to 50-1 would send silver well past $60. If the ratio returns to its historic low of 15-1, silver could exceed $200 an ounce, a number that seems impossible to many today, but one that aligns perfectly with past market behavior. But what's driving this imbalance? Why is silver so dramatically undervalued compared to gold? The answer lies in years of price suppression, excessive paper trading, and a manipulated market structure that has artificially kept silver's price far below its true value. For decades, banks and institutions have shorted silver through futures markets, keeping prices suppressed while accumulating physical metal behind the scenes. But as we've already seen, the paper market is unraveling, and when silver breaks free, its move will be explosive. And here's where things get even more interesting. The moment silver starts breaking key resistance levels, especially $35 and then $50, the momentum will accelerate. At that point, retail investors, hedge funds, and even institutional money will pour in, triggering the kind of FOMO-driven buying that could push silver to triple digits faster than anyone expects. So the question isn't just whether silver will follow gold. It's how fast and far it will run once the ratio begins to collapse. The data is clear. Every time gold surges, silver follows with even greater intensity. And this time, with record-high debt, collapsing fiat currencies, and industrial silver demand skyrocketing. The conditions are more extreme than ever before. But there's one more factor that could send silver's move into hyperdrive: the inevitable short squeeze on the banks and institutions that have been suppressing silver's price for years. When they're forced to unwind their massive short positions, silver could enter a parabolic move that shocks the entire financial world.
Allow the banks in the West to clean up their balance sheet, in London especially. And then you would slowly turn up the heat, get as much of it as you can, let the price rise, let JP Morgan control both GLD and SLV. I mean, you can see the pieces are in place for if they wanted to do this, they really could. And the rumor is that he's very angry at the European aristocrats. He believes they're behind the color revolution we've experienced here in the West. He believes they're behind any election integrity issues. That's the rumor, and that he's trying to blow up these European banks who are in big trouble with massive, massive, massive short positions, unallocated, in an environment where they've set off the delivery binge on top of what the BRICS have quietly been doing. And if we see an acceleration, yeah, I mean, all manipulations always eventually end in spectacular fashion. Could this be what we are seeing? You know, I hesitate to say it because I feel like the little boy who cries wolf, but it feels that way. And it feels like it's being set up to where they could do that. I guess we'll see. But at this point, then again, when we're so far indebted and have done so much to destabilize not only the monetary side of things, but actually our national security as it pertains to the future with our issues with indebtedness, with lack of treasury demand. Since since 2014, no one's bought any treasuries. No central bank has. Sure, they bought some, but the amount of selling by treasuries has outpaced the buying since 2014. And in that environment, how do you establish confidence and credibility? Well, you do what Judy says. You issue 50-year treasuries backed by gold. You bring all that gold home. You get the banks here in the West out of trouble and let the price rise. Could that be what we're seeing? Yeah, maybe. And you're not going to get anyone to take our treasuries as is just by promising. And here, you know, they're trying to lower rates again. You know, the economy is slowing down. You know, I just think that this is a situation where they realize this is a necessary step. Seems like that's what they're doing.
For years, banks and institutions have manipulated silver prices by shorting the market, placing massive paper bets that push the price down while they quietly accumulate physical metal behind the scenes. But this system of artificial price suppression is now on the verge of collapse. A historic short squeeze is brewing, and when it finally erupts, silver could explode past $100 in a matter of days. Andy Schectman has repeatedly warned that there is far more paper silver in existence than physical silver to back it. The COMEX and LBMA have built a system where banks trade enormous amounts of silver contracts that are completely detached from the actual metal supply. But here's the problem. Those contracts are only valid as long as investors don't demand delivery. If too many people start asking for real silver instead of paper promises, the system breaks. And we are already seeing the first signs of that happening. In the past year, COMEX silver inventories have been drained at an alarming rate. More investors are opting to take physical delivery rather than roll over their contracts. And as a result, available silver stocks have been plunging. At the same time, central banks, institutions, and sovereign wealth funds are accumulating precious metals at a record pace, meaning that once silver supply tightens even further, the banks that have been shorting silver will be caught in a trap they cannot escape. Here's how the short squeeze unfolds. Physical demand drains available silver supply. As investors lose confidence in paper silver and demand real metal, vaults get emptied. The COMEX and LBMA can no longer meet delivery requests. Once inventories fall too low, exchanges will have no choice but to settle contracts in cash rather than metal, exposing the fraud behind the paper market. Traders panic, covering their short positions. Banks and funds that have been betting against silver will scramble to buy back contracts, creating an avalanche of buying pressure. Silver prices skyrocket as panic buying accelerates. Once silver breaks key price levels, momentum traders and institutions will flood in, sending silver to new all-time highs. We've seen this happen before. In 1980, when the Hunt brothers attempted to corner the silver market, prices surged nearly 10 times in just a few months. In 2011, silver spiked from $9 to $50 as investor demand overwhelmed supply. But this time is different. The level of manipulation has never been greater, the supply deficit has never been deeper, and the institutional money flowing into silver has never been stronger. And once silver breaks out, the psychological shift will be unstoppable. Right now, most people still believe silver is just another commodity. But when they see silver move from $35 to $50 to $100 in a matter of weeks, the floodgates will open. Retail investors will rush in, institutional traders will pile on, and the very banks that have been suppressing silver for years will be forced to buy back their own short positions, fueling the fire even further. This is why silver's next move won't be gradual, it will be explosive. Once confidence in the paper, silver market collapses, price suppression will end, and silver will be free to rise to its true market value. But the biggest gains won't come from silver alone. There's another way to leverage this breakout that could yield even greater returns. Silver mining stocks.
Got to have a roof over their heads, as it were. So that, I think, is another line of defense. But of course, if you're investing in property, or if, let us say, you are living in a bigger house than your circumstances warrant, then you are exposed to a real problem. You're going to end up with big negative equity, even if you manage to play the game a little bit to persuade your lender not to foreclose on you, but to foreclose on someone else before you. I mean, it's not going to be a happy situation, but you've got to have a roof over your head. So, you're probably stuck with a mortgage where you are. Just don't, I think. Actually, I mustn't wander into giving advice on this sort of matter. But I think it would be absolute folly to if you like, try and take advantage of falling property prices to leverage up your position. I mean, there will come a time when you could do it, but that will be very close to the final collapse of the currency, not while it is still going down. Because as it's going down, interest rates will rise. I mean, if you think it's crazy that interest rates will rise while the economy is in such a mess. Just imagine that you were in Germany in 1922, 1923, when the mark was collapsing. What sort of interest rate do you think existed? It was probably a lot less than warranted by the collapse. But, if you're going to borrow anything, I mean, you are going to pay very, very high interest rates. Because it's the only way in which you'd be able to obtain any currency. And indeed, people made fortunes doing that. We had Hugo Stinnes, the inflation king. who founded all sorts of companies, and one stage owned roughly 25% of Germany in terms of productive assets. He, unfortunately for him, died on the operating table in 1924. So he didn't live long enough to enjoy his fabulous empire that he had.
Silver's breakout past $100 will create massive wealth for those holding physical metal. But for investors looking for even greater upside, silver mining stocks could be the ultimate play. In every major silver bull market, mining stocks have outperformed the metal itself, delivering 500% plus gains as silver prices surge. And this time, with silver primed for an explosive move, silver miners could be on the verge of a historic rally. Francis Hunt has emphasized that silver miners are like a leveraged bet on silver itself. When silver moves higher, mining companies don't just benefit from the rising metal price, they also experience margin expansion, meaning that their profits increase exponentially. This is why, during silver's 2011 run to $50, many silver miners didn't just double or triple, they rose by 500% or more. Let's break down why silver mining stocks could see their biggest gains ever in the coming years. Silver's move past $50 will drive institutional money into miners. Most investors don't buy physical silver. Instead, they buy mining stocks, ETFs, and leveraged plays. As silver surges past key psychological levels, hedge funds and large institutions will pour into silver mining stocks, causing massive price spikes. Silver miners are still drastically undervalued. Unlike tech stocks and major indices, silver miners haven't priced in silver's next move yet. Many mining stocks are still trading at deep discounts relative to their historical valuations, meaning the upside potential is enormous. Mining companies are generating record cash flow. Even at current silver prices, many miners are profitable. But when silver explodes higher, those profits will multiply, turning even small-cap silver producers into billion-dollar companies almost overnight. The discovery premium will return. In past bull markets, silver exploration companies, those that discover new silver deposits, have delivered the most extreme gains. When silver starts running, speculative capital floods into the junior mining sector, sending small stocks 10x, 20x, or even 50x higher. Historically, silver miners tend to lag behind silver at first. But once the metal breaks key resistance levels, miners rocket past it. This is why smart investors aren't just stacking silver bars. They're also positioning themselves in select silver mining stocks that could deliver life-changing returns. But there's a key question. How high will silver go? Analysts are throwing out numbers like $100, $200, or even higher. But what does history tell us? And more importantly, what do the biggest experts in the industry predict for silver's ultimate price target?
What does all of this mean for gold? At the end of the day, you're a gold and silver channel. What does this all mean? Debt-based system collapse across the Western nations will be the turbo juice, because that liquidity will seek a home. It's not going to run into stock markets. It's not going to run into debt instruments of any variety, although you might get bond funds moving out of European debt into US debt a little bit because they have to be in debt. But the smart, the people with the free remits are going to be chasing the final reserve asset, the insurance policy, when proliferate central bankers all come to a sticky end. And that is truth, money, and that is gold. So unfortunately, as bad as some of the repercussions this is for the citizens, as gold investors, we are insurance when houses get burnt down. And there's a lot of people starting fires, a lot of very dumb people, and I would say with intent, manufacturing a contagion, orchestrated, controlled demolition of their economies. And you have to look at everything Germany has done as the spinal column of the EU in terms of their energy policy, the pursuit of the green policy, what that's done to Volkswagen and BMW and Mercedes, which are selling for below net asset value in at times where China's being super competitive, is absolute destruction. The walk away by Merkel on the nuclear option, which was both cheap and safe, all of these decisions have been to undermine the viability of their economies. So a real Western economic collapse. This is reset. And what we said to you last time has come about, and we're now seeing greater effects of that. Trump and Elon's cuts are going to force contagion. Unemployment's going to lead to less income tax take, more debt needed to fund. It's going to more welfare checks. You're going to see a reduction in services, and it's going to go through the whole Western world. So it's not an attack I'm only levying at America and American citizens. This is a Western world hegemony going down.
Timing is everything. Silver's explosive breakout isn't just possible, it's imminent. The debt crisis, central bank panic, and collapsing paper markets have created the perfect setup for silver's biggest bull run in history. But the critical question remains, when will it happen? Are we months away, or is this a multi-year setup? Looking at past silver bull markets, the pattern is undeniable. Silver lags behind gold at first, but once it breaks key resistance levels, it surges faster and more violently than anyone expects. Right now, silver is consolidating below $35, a critical level that has acted as major resistance for over a decade. But once silver clears $35, the floodgates could open. The next major test? $50, the 2011 high. Francis Hunt has pointed out that markets move in cycles, and silver is entering the most explosive phase of its cycle. The last time silver was suppressed this severely, it rocketed nearly 1,000% in just a few years. And with gold already making new highs, silver's move is not a question of if, but when. Here's what's happening right now that suggests silver's breakout is closer than ever. Gold has already broken out. Every major silver bull market starts with gold leading the way. With gold surpassing $3,000, silver is primed to follow. Physical supply is vanishing, COMEX and LBMA inventories are being drained, and industrial demand is rising. Once supply tightens further, silver prices will respond violently. The Federal Reserve is trapped. Interest rates have reached unsustainable levels, and central banks are now forced to print more money. This will accelerate the flight to hard assets like silver. De-dollarization is accelerating. BRICS nations and major economies are ditching the dollar, leading to massive central bank gold purchases. Silver will follow as monetary systems shift. Once silver breaks $35, momentum traders, institutional investors, and retail buyers will pile in. But when silver breaches $50, the move could go parabolic, triggering a buying frenzy unlike anything we've seen before. Analysts who once called $50 silver crazy are now revising their targets to $100, $200, or even higher. So where does this leave us? The opportunity is now. The world is still asleep to what's coming, but the signs are everywhere. Those who position themselves before silver's breakout will be the ones who benefit the most. But the final step is crucial. What is the ultimate conclusion to all of this? What does silver's coming explosion really mean for the financial system? And how should investors prepare?
Structure and all the rest of it. But it's a wonderful business because the regulator basically says, we will calculate what you have to do so that you make a return for your shareholders of 8%. Okay? So you've got a utility 8%, guaranteed by the regulator in effect. Now, it wasn't meant to be like that, but that's actually the way it works. So you get private equity businesses from America or wherever who look at this and think, this is something we can leverage up. And particularly when interest rates drop to zero, I mean, hooray! We can really leverage this up. So, you can turn an 8% return leverage 5 times into a 40% annual return for the private equity boys. I mean, lovely stuff. Until you got to refinance it. And of course, what happened was that interest rates rose. Nobody expected it, but interest rates rose, and suddenly Thames Water is bust. And we've got this, that's what's happening. And it's happening around the world, not just Thames Water, but I mean, it was the consequence of earlier suppression of interest rates by the central banks. So what do you do now? Do you lend money to Thames Water? I mean, you say, Thames Water might approach you as a banker and you'll say, well, we're not too sure about this. What government guarantees can you obtain? Then we might consider it. I mean, the whole thing is an absolute mess. And the underlying point is there is so much zombie debt within the private sector that higher interest rates, which are inevitable now, are going to drive the whole economy under. This is why it's so dangerous at this juncture, at the top of the credit bubble, to have trade tariffs coming in, as they did in 1929, 1930. Smoot-Hawley Mark II. That's what I call Trump's, beautiful word. I really do see that.
Silver's moment is coming. And when it does, the financial world will never be the same. For years, it has been suppressed, ignored, and undervalued. But now, the forces driving silver's breakout, the collapse of fiat money, the debt crisis, the breakdown of paper markets, and surging industrial demand, are all converging at once. This is the perfect storm, and silver is about to become the most explosive asset of the decade. History has shown that when silver moves, it moves fast. Gold has already shattered records, and silver is next. The gold-silver ratio is at extreme levels, screaming that silver is historically undervalued. Supply is tightening, industrial demand is surging, and central banks are losing control. The only thing missing, a trigger. Once silver breaks $35, the first wave of buying will begin. Hedge funds and institutional traders will start piling in. Once silver surpasses $50, the 2011 high, the true mania phase begins. The mainstream media will finally wake up. Retail investors will rush in. And those who position themselves early will watch as silver skyrockets past $100, then $200, and possibly even beyond. And here's the bigger picture. This isn't just about silver. This is about the end of a monetary era. The fiat currency system is dying. The debt-based economy is unraveling. Central banks are trapped, and the only way out is devaluation. In every major monetary collapse in history, silver has played a crucial role as real money. This time will be no different. The question is, will you be ready? The signs are clear. The stage is set. The smart money is already making its move. The only thing left is to decide, will you be on the right side of history when silver makes its final breakout? If you found this valuable, make sure to subscribe and stay ahead of the biggest financial shift of our generation. And remember, this is not financial advice. Always consult a professional before making any investment decisions.
Spain, and of course Cyprus. There's an interesting history with Cyprus in there. We had a beautiful little squeeze here in the interest rates and the far larger squeeze here, and our targets are indicating for German debt that you're actually going to go from 2.5, from sub 2.5 at one point, to through 4%. Now that is a huge in percentage change, logarithmic change in cost of interest for Germans. And part of that's going to dovetail with the military-industrial complex thing that I spoke about, short American military-industrial complex. Trump wants peace. He wants less expenditure on NATO and on maybe the UN, pulling in the horns a little bit on all these costs, having to cut his cloth. So if the Europeans have to start issuing more debt to build their own military up, what you're already seeing is the debt markets baking that in and charging much more for that to be the case. The debt valuation and issuances are not attractive. They're not being bought up, and the rates demanded are going substantially higher. That's a 4% move on a nation used to 2.5% funding. And I know in America you'll say 4%, not a big deal. Hang on. If you've been financing and living at sub 2.5, 4% is a better part of an 80% increase there in your interest payments. So what's happening now for America is going to be happening soon for Europe as part of the debt-based collapse. So you had the dollar dominance and the dollar debt collapse. Now you're getting the euro going up, and you're getting the euro debt starting to show its collapse. So you can see how the different economic zones are going through the same processes, but just not at the same time. So they synchronized, you go first, then me, etc. Now you might say, well, that's just Germany. So I'm going to do the same for you on the second biggest nation in the EU, and that is France, as some of you will be crying out. And if we put in the French 10-year yield, and we go into all so that we can find it, you'll see a very similar structure and setup. Again, a very similar structure and setup for us here. So I'll just put that same draw tool on and go, okay, here we are. That's France. And you'll see from this draw that we're expecting